The board loves to trick you with examples of capital and revenue expenditure. So don't lose marks by guessing. Let's look at the PPT and crack this year's board exam. Every business organization has to have a record of its capital and revenue. Capital and revenue can be shown as expenses as well as income. Let us know the meanings of capital expenditure and revenue expenditure. Capital expenditure are those expenses whose benefit is not exhausted within the current year. Rather, it is enjoyed for a long time period and therefore they go non-recurring in nature. They are adjusted or shown in the balance sheet of the final accounts. For example, purchase of machinery, land or building, installation charges of new equipment, cost of erecting new office or factory, or additions or extensions to existing assets. Moving on to revenue expenditure, these are such expenses whose benefit is exhausted within the current year and therefore they are recurring in nature and do not result in the acquisition of any permanent assets. Now, this can be well explained through examples like payment of rent, salary, wages, electricity bills, cost of goods that are purchased for resale, any kind of a repair, maintenance, and carriage on goods or insurance premium. Such expenses are adjusted in the trading and profit and loss account of final accounts. Now that we are clear about the expenses, let us move to the capital receipts or say capital income. Capital receipts are that particular income which is non-recurring again in nature and it is raised or involves creation of liability or reduction in the value of fixed assets. For example, any amount that is received by say way of loans, capital raised by an issue of say shares or debentures. This particular receipt is basically from selling any fixed asset and not for normal trading. This is shown in the balance sheet, whereas on the other hand we have revenue receipts or revenue income. This is obtained during the normal course of business operation and are of recurring nature. Any sale proceeds of goods and services, interest or dividend received, and rent received are various examples of revenue receipts. They neither create a liability nor involve reduction in the value of fixed assets. Next, let us move on to understand the deferred revenue expenditure. Deferred revenue expenditure is that expense whose benefit extends beyond the current accounting year. The word deferred means to be delayed. For example, any heavy advertising expenditure which is incurred in order to introduce a new product in the market would be regarded as deferred revenue expenditure. This is shown on the profit and loss account, and only a part is written off each year. Some other examples are like preliminary expenses while formation of a company, heavy loss by fire not fully covered by insurance, etc. And that is how you get full marks. If this made accounting easy, hit subscribe and click right here to check out our Class 10 Commercial Studies playlist for the next chapter. See you there.